Your core banking system is costing you $4 million a year in hidden losses, not maintenance fees. Opportunity cost. While you've been scheduling another meeting about modernization, digital-first competitors processed loans in minutes, launched new products in weeks, and captured the customers you thought were loyal. Every day you wait, that gap widens. Can you afford another quarter? By the end of this video, you'll understand exactly why legacy core systems are bleeding profitability faster than your quarterly reports. Reveal how to calculate your actual opportunity cost, and what institutions half your size are doing right now to leapfrog ahead. This isn't theoretical. This is happening in your market today. I'm Marcus Chen with Advanedge Consulting, and this is Episode 2 of our Core Banking Modernization series. If you're a banking executive, CFO, or technology leader wondering why digital transformation keeps getting delayed, this one's for you. Let's start with a number most banks don't calculate. $4 million. That's the average annual opportunity cost we've identified across mid-sized institutions still running core systems built before smartphones existed. Not the cost to modernize. The cost of not modernizing. Here's where it's hiding. First, product launch velocity. A regional bank we worked with wanted to launch a new small business checking product. Simple offering, competitive rates, digital onboarding. Their legacy core system required 9 months of development, testing, and integration work. 9 months. Their digital-first competitor launched 3 similar products in that same time frame, tested them in market, killed one, and scaled 2. By the time our client went live, the market had moved. They captured 11% of their projected customer acquisition. The revenue gap? $1.2 million in year 1 alone. Second, operational efficiency drain. Manual processes, batch processing overnight, reconciliation errors that require human intervention. An institution we're currently helping calculated that their commercial lending team spends 43 hours per week on tasks that modern systems automate completely. 43 hours. That's more than one full-time senior lender doing administrative work instead of building relationships and closing deals. When you multiply that across departments, you're looking at hundreds of thousands in pure productivity loss. Third, customer attrition you can't see coming. Your NPS scores might look fine. Your customer surveys show satisfaction, but your digital experience scores 32 points lower than neobanks in speed, convenience, and mobile functionality. The customers you're losing aren't the ones complaining. They're the high-value relationships who quietly move their primary banking to institutions that respect their time. A community bank we assessed lost 18% of their under 40 account holders over 3 years. They attributed it to market dynamics. The data showed something different. Every single exit interview mentioned digital experience frustration. Fourth, compliance and risk exposure. Legacy systems weren't built for real-time fraud detection, BSA, monitoring, or the regulatory complexity we face today. One institution we work with was manually reviewing transaction alerts that modern cores flag, prioritize, and resolve automatically. Their compliance team was drowning in false positives while actual suspicious activity slipped through gaps in their process. The FDIC noticed before they did. The consent order didn't just cost money. It cost board confidence and strategic momentum. Now here's what makes this particularly painful. The technology to solve this isn't experimental anymore. The big 3 core providers, Fiserv, Jack Henry, and FIS, collectively serve over 70% of U.S. banks, and their modern platforms are light years ahead of the systems many institutions are still running. We're not talking about untested fintech startups. These are established partners with proven modernization pathways. Fiserv's DNA platform, Jack Henry's Scimitar, and Silver Lake Core's FIS's Horizon and IBS solutions. These aren't just upgrades. They're complete reimaginations of what core banking infrastructure can do. A PI-first architecture that enables integration with best-in-class fintech solutions. Real-time processing that eliminates batch cycles and overnight delays. Cloud-native deployment that scales with your growth instead of constraining it. And here's the shift we're seeing across institutions that have made the move. They stop thinking about their core as a transaction processor and start leveraging it as a platform for innovation. Want to integrate a digital lending solution? Modern cores make that a weeks-long project. not a multi-year initiative. Need to launch embedded banking services for a commercial client's ecosystem? The API infrastructure is already there. Speaking of lending, this is where the opportunity cost becomes crystal clear. Institutions we work with are integrating modern loan origination systems like Abrigo to completely transform their lending operations. Abrigo isn't a core banking provider, but as a best-in-class LOS, it accelerates lending workflows in ways that legacy systems simply can't match. We're talking about credit decisions in hours instead of days, automated document collection, real-time risk assessment, and portfolio monitoring that gives lenders competitive intelligence they've never had before. One institution, we helped integrate Abrigo with their modernized core cut, their commercial loan approval cycle from 11 days to 36 hours. Think about what that means in a competitive deal situation when a business owner is comparing offers. Speed is often the deciding factor. The bank that says yes first with confidence wins the relationship. That's not just one loan. That's the operating accounts, the treasury services, the executive's personal banking, the employee payroll. That's a full relationship that legacy speed loses to modern velocity. The pattern we see across successful modernization projects follows a specific sequence. It starts with honest assessment, not what your core provider tells you the system can do, what it actually does in your environment, with your team, under your constraints. Most banks discover they're using about 40% of their current system's capability, which means the gap isn't just the technology, it's organizational readiness. Next comes strategic prioritization. You can't modernize everything simultaneously. The institutions seeing the fastest ROI focus on their highest value use cases first. For some, that's digital account opening. For others, it's commercial lending operations or treasury management. The key is picking the area where modern capability creates immediate competitive advantage and revenue impact. Then integration architecture. This is where Advanedge helps clients navigate complexity. Your core banking system doesn't exist in isolation. It connects to your digital banking platform, your loan origination system, your payments infrastructure, your CRM, your data analytics tools. Modernizing the core without a clear integration strategy just creates expensive chaos. We help institutions design that architecture before they start ripping out infrastructure. Regulatory navigation is the fourth critical element. Your primary regulator has opinions about core banking changes, and those opinions matter. The institutions that modernize successfully bring regulators into the conversation early, demonstrate risk management protocols, and show clear business continuity planning. This isn't something to figure out during implementation. This is foundational work that happens during planning. Finally, change management that actually works. The biggest risk in core modernization isn't technical failure, it's organizational resistance. We work with institutions to build internal champions, create training programs that stick, and design incentives that align behavior with new capabilities. Your team doesn't fear change. They fear looking incompetent during change. Address that, and adoption accelerates dramatically. Here's what this looks like in practice. A bank we recently helped had been discussing core modernization for 4 years. 4 years of committees, RFPs, vendor presentations, and paralysis. Their board kept delaying the decision because the price tag felt too high. We helped them calculate their actual opportunity cost using the framework I just shared: product velocity losses, operational inefficiency, customer attrition, compliance risk. When they saw the $4.7 million annual gap, the conversation shifted immediately. Suddenly, the investment wasn't an expense. It was damage control. The future belongs to institutions that recognize this reality. Your core banking system isn't back-office infrastructure anymore. It's the foundation of your competitive positioning. Every quarter you delay modernization, you're making a conscious choice to fall further behind institutions that have already made the move. The cost of waiting is higher than you think. The next video proves it.